I'm joined now by Oreoluwa Odetunde, who's the head of research at Ancoria Asset Management, to review some of our top stories in more detail. Good morning to you. Thank you so much for joining us. Great to have you. So, I mean, look, that big sell-off that we saw in the U.S. markets, $5 trillion over like a 3-week period. What did you make of it all as far as the triggers?
Yes, I think that, it was a lot.
Yeah, a lot.
When we start to see why some of these losses materialized in the market, first, I think investors started to worry that the market was already overvalued. If you take a look at the S&P 500 in the last 2 years, when the bull run started in October 2022, the S&P 500 is up of over 70%. And if you look at the price to earnings ratio of the market as well, you see that, as of 2024, price to earnings ratio is around 25 times earnings. And usually that was much more above the average of around 16 times earnings. So definitely that started to unsettle investors. Then when you take a look at, there was a survey done by the Bank of America on bull runs in the market, and we know that typically in the third year of a bull market we tend to see that the market is much more volatile, it's much more turbulent. So some of these losses were in a way already expected by investors. And then you also look at the fact that there's a lot of policy uncertainty from the Trump administration, conversations around immigration, around tariffs implementation and all of those things. So investors started to price that into the market. They started to price down a lower growth rate for the US economy especially, and so that was what led to a lot of the losses that we saw in the market. And if you now look at where most of these losses were really focused on, you see that it was really majorly in the tech sector. And we saw that the NASDAQ, which is a tech-heavy index, I think it lost about 11% from when it touched an all-time high in February. So investors definitely sold down on most of the stocks in the sector. You'd see like the likes of Nvidia had increased by over 500% in the last 2 years. So definitely those sell-offs were kind of expected. But I think the interesting thing to note about the tech sector is that one, the market is still pricing in a lot of earnings growth from the tech sector, despite the significant earnings that we've seen in the last 2 years, majorly supported by the whole AI theme. And we also see that free cash flow for the tech sector as well is about 30% of total revenues. And when your free cash flow is higher, it means that your business becomes more valuable. And if your business becomes also more valuable, the stock market would definitely start to price that into this market's performance as well. So definitely we do still expect robust performances in the US market. Secondly, we also still think that corporate earnings should still remain very solid. I think there's a lot of news, a lot of mixed bag data more or less, conversations around job losses, immigrations and all of those kind of things. But I think corporate earnings are still expected to remain solid. And if those fundamentals still remain very solid, I think that will continue to push stock market activities.
All right, so you're a bull. You're optimistic on the U.S. market going down. All right, so speaking of bullish activity, we had some corporate news, M&A news, if you will, with Pepsi and this $1.95 billion purchase of Poppi, the prebiotic soda. As far as the deal is concerned, what do you think it says about the industry with Pepsi's motivations to make that purchase?
I think it says a lot about the industry and a lot about consumers' taste preferences as well. And I think it has further re-emphasized that consumers' preferences are changing. Consumers they are more conscious of health. They want more healthness and wellness products. So we are seeing an expansion in terms of maybe like the diet industry. It's booming. Investors are getting more conscious about what they're taking into their bodies. They want more healthier products. And that's why we've seen, an uprise of companies like Poppi. So if you we also, from this acquisition, we're also able to see that, it's a fast-growing industry. So, for instance, we saw that Poppi in 2024 was able to increase its revenue by over 160%, and it was able to deliver a revenue of around $500 million, which is very significant for a company that just began operations in 2018. So, definitely, the industry is fast. That's where it's seeing increased pressure from competition. We know that Pepsi also, Coke also launched a very similar similar product, Simply Pop, in February, and then we are seeing PepsiCo's acquisition of Poppi as well. So definitely more competition is happening. And I think one thing we've also learned about the industry is that it's been able to command a higher price premium from consumers, and that's something that we've seen that traditional soda producers have somewhat struggled with, passing on those higher costs to their consumers. But we see that these products are able to do that much more comfortably than traditional soda producers. And for the likes of PepsiCo, that their margins have been struggling for a while, I think it's a good addition to their portfolio of drinks. So definitely we do expect that the industry should still continue expanding. It's fast growing. We're seeing a lot more players in the industry as well. We are seeing that consumers are now much more conscious about what they're taking into their bodies. I think I was looking at a data by the International Food Council that said 40% of shoppers are now considering these health-focused products as alternatives to traditional soda. So it's a booming market. So and if this demand is sustained, the industry will continue to accelerate. And I think for Poppi, for instance, we saw that Poppi had a market share of around 2% of the US soda market in 2024, and I think it was less than 1% in 2023. So the growth is fast. Increased focus on health products is happening so much. So definitely we think that we will continue to support demand, and we see fast rising industries for the functional beverage market.
Fantastic. You sound like a consumer goods analyst. Really great breakdown there.
No, not really.
Let's go back to the US economy, and there were a lot of central bank decisions this past week, just from all over the world. I think we'll get to Japan in a second, but they held rates in place, but they did downgrade their forecast for US growth. What kind of impact do you think that will have on, I guess, businesses, consumers, and so on?
So I think that this particular meeting that we had, there was a lot of uncertainty communicated by the Fed chair, Jeremy Powell. And that's because they don't necessarily know where inflation is expected to be. They did give projections, yes, and they expect that inflation would be higher, but there was a lot of uncertainty in his statements. Same as growth as well. It's expecting that growth should slow down, I think, to around 1.7%, and we know that typically is always around 2% levels, especially in 2024. So uncertainty was communicated a lot. But I think a good thing is that one thing that they mentioned that they've started to also track with soft data. They mentioned, hard data, they've been tracking hard data like inflation, like GDP and all of those, but they're also tracking soft data now. So this soft data mean things like consumer confidence surveys, they mean things like retail sales and all of those things. So, and we know that before we had that particular meeting happen, we saw a consumer confidence survey that was released by the University of Michigan, and they had already said that a lot of consumers and businesses were already pricing in higher inflation into the economy. I think their forecast for inflation in a year from now is about 4.9%, which is very significant for inflation that is around 2% levels. So definitely, there's the growing sense of pessimism coming from a lot of consumers and businesses, which has not also been is not also very good for consumer spending. So if you take a look at what makes up the most GDP for the United States, you'd see that it's really consumer spending that has really driven the GDP. I think consumer spending is about 75% of total GDP. So if investors are expecting that inflation is expected to remain high, I think we might start to see consumers cutting back on their discretionary spends, businesses also doing the same. And when consumer spending is starting to get weak, I think GDP would also start to get weak as well. If you also take a look at the fact that they are expecting that the rate cuts that is expected in the market, I think they were pricing in around 3 rate cuts as of last year, but now those rate cuts are somewhat moderated to around 2, and some people have been pricing in just 1 rate cut in 2025. So definitely when you combine all of these factors, I think it signals a bit more pessimism for consumers and businesses. But I think one thing that we've noted about this particular Fed is that they tend to be very data-driven. So should we see weaknesses in the labor market? Should we see weaknesses in terms of economic growth very significantly? I think we should start to see them respond with rate cuts. Fantastic. We are unfortunately out of time. I wanted us to jump on Japan and Nigeria, but yes.
Oreoluwa, great analysis. I'm going to have you back on the show. Head of Research at Ancoria Asset Management, Oreoluwa Odetunde. Thank you so much for your time.
Thank you for having me.